Entry, stop loss and target. These are the three elements of every trade. Let's start with the very first one, which is called as entry. Entry is the act of opening a position in the market. This is the price at which an investor buys or shorts an investment. The entry point is usually a component of a predetermined trading strategy for minimizing investment risk and removing the emotion from trading decisions. Recognizing a good entry point is the first step in achieving a successful trade. With a good entry, we have three advantages stacked in our favor. The first one is you will always be having less risk with a large profit potential and high probability that the trade will work out in our favor. Let's try to understand this with an example. Let's assume, based on my methodology, this is an area on the chart where I'm expecting prices to turn up. This can be based on a number of factors, which can be support and resistance, which can be based on some Fibonacci levels, can also be based on your demand and supply analysis. So let's assume this is an area where I'm expecting prices to move up, and 100 rupees is where I would like to enter the trade. And if the price goes anything less than 98, I would like to exit the trade with a small loss. And based on the analysis, we are also expecting a target of 110. If I buy this stock at the current market price, my profit potential would be this much, and because I'm expecting the prices to turn from the 98 to 100 levels, this is the loss potential or the risk potential which I have on that trade. If I wait for some time and let's assume that the prices are a little lower now, what has happened now is my profit potential has increased and my risk potential has reduced. If I wait some more time, now I have even bigger reward for smaller risk. And waiting for some more time, let's assume the prices are exactly at my entry price, which is 100, which is where I'll be having the maximum reward for the least risk. And because this was also planned based on some predefined methodology, which could have been demand and supply, which could have been, as like I said, support resistance, or also your Fibonacci levels, this is where we are expecting prices to move up, which also stacks very high probability that it can be a trade which goes in your favor. Once you get your entry, the other two elements are basically your stop loss and targets. If you look at stop loss and targets, both of them are your exit. One of them is a loss exit, which is called as your stop loss, and the other one is your profit exit, which is called as your target. Again, coming back to the same example, because I was expecting that if the prices they don't turn from the 98 to 100 level, prices can go further down. This is where I'll be having my stop loss order, which will help me incur small loss instead of incurring a very big loss. So let's assume prices they come to my zone, and what happens is prices they move up. If the prices are moving up, I'm definitely making money on this trade. But just in case prices they don't move as expected and they start going against me, I can have a very big loss on this trade. To minimize that loss, I will be using an order which is called as a stop loss order to minimize my loss from a very big loss to a very small loss, and that is what is called as a stop loss order. Therefore, a stop loss order is used to minimize your risk on that trade, and by having that stop loss order, we are always assuring that we will not be incurring big losses but small losses in case the trade doesn't go in our favor. The next kind of an exit is called as your target, and target is always your profit exit. So let's take the same case, prices they come into my zone, and now I'm expecting prices to turn up from here, and I'm expecting a target of 105. If prices go to 105, I can close my 100% position and make some money on it. We can also have multiple targets, because of which what I can do is I can probably book 50% of my profits at 105 and the balance can be booked at 110. That is the reason having your targets can permit both small gains and large gains. If you're exiting your complete position at one single price, it can be a small gain, but if you're exiting at multiple targets, you can have larger gains. In summary, when placing a trade, always include these three orders, which is called as your entry, which is where you are entering the trade, your stop loss, which is helping you minimize your risk on that trade, and your target, which is helping you book your profits once the prices has reached your desired exit price.